Welcome to Finance Deep Dive. All right, today we're jumping into the wild, high-stakes world of stablecoins. You know, these things promise to be the best of both worlds, the rock-solid stability of the dollar, but with the lightning speed of crypto. But, as we're about to find out, it's one heck of a gamble. So, here's the big question we're tackling today. Is this stuff the actual future of money? Or is it all just a giant house of cards, ready to come tumbling down? Stick around, because in this video, we are absolutely going to find out. And just to give you a sense of the scale we're talking about, look at this number, $5.6 trillion. That's how much money has already moved through stablecoins just in 2024. This isn't some tiny niche corner of the internet anymore. Oh no, this is a massive global financial force. Okay, so what exactly is a stablecoin? Well, in the simplest terms, think of it as a crypto token that's designed to always be worth exactly $1, 1 to 1. The whole idea is to get the super fast transactions of digital currency without the crazy price swings. You know, the best of both worlds.
So, why do we even need these in the first place? Well, it all boils down to what you could call crypto's biggest headache.
I mean, think about Bitcoin. Its price can go on an absolute roller coaster in a single day. Imagine buying your morning coffee. It might cost you $3 1 minute, but by the time you've finished it, the price has jumped to $5. That kind of wild volatility makes it pretty much useless for everyday stuff. And that is the exact problem stablecoins were invented to solve. Right, but here's the thing. Not all stablecoins are created equal. There are basically three main flavors, each with a totally different way of trying to keep its value stable.
First up, you've got the most common kind, fiat-backed stablecoins. The best way to picture this is to think of a digital poker chip. It works just like this. You go to a company, think of the big ones like USDC or Tether, and you hand them one real US dollar. They take that dollar, stick it in a boring old bank account, and in exchange, they mint you one digital token worth $1. Want to get your real dollar back? You just trade your token back in. It's supposed to be a simple one-for-one deal.
Okay, next up is flavor number 2, crypto-backed. Now this one's less like a bank and a lot more like a digital pawn shop. So instead of backing your stablecoin with dollars, you lock up other cryptocurrencies like Ethereum. But since crypto prices are so jumpy, you have to put up more than what you borrow. So you might have to deposit, say, $150 worth of ETH just to get $100 worth of stablecoins. That extra $50 acts as a safety buffer in case the price of Ethereum drops. The big player in this space is a coin called DAI.
And that brings us to the third and, by far, the riskiest type, algorithmic stablecoins. I want you to picture a robot walking a tightrope over a canyon with no safety net. Why? Because these things aren't backed by dollars or even other crypto. They're backed by, well, nothing but complicated code and pure faith in an algorithm.
So what happens when that robot on the tightrope starts to wobble? Even the Federal Reserve put out a warning saying this kind of model could be, and I quote, fundamentally fragile. Turns out that was a massive understatement.
Which leads us to the story of TerraUSD. And what happens when the peg doesn't just bend, but shatters completely.
Okay, so here's how it all went down in May of 2022. It started with a huge sell-off of TerraUSD, or UST. This sparked a full-blown digital bank run. Everyone was trying to get their money out at once. The algorithm that was supposed to keep it stable totally panicked. It went into what's now famously called a death spiral and started printing trillions of its sister token to try and fix the problem. And the result? The value of both just collapsed. Poof. Billions of dollars gone, practically overnight.
That phrase, a self-reinforcing death spiral, perfectly captures it. The more it fell, the more it printed, and the more it printed, the faster it fell. It was a brutal, brutal lesson for the entire industry. You can't just code trust into existence.
All right, wow, that was pretty intense. Look, if you're getting some value out of this breakdown and you want to see more deep dives like this, it would be awesome if you'd hit that subscribe button. Seriously, it really motivates us to keep making these videos for you. Okay, so after a disaster like Terra, you'd probably think stablecoins would be dead in the water, right? Well, not exactly. In fact, you could argue they're more important than ever. And not just for crypto traders. They're quickly becoming the new rails for global payments. Just look at the difference here. If you want to send money overseas using the old system like Swift, you're waiting 1 to 5 business days, paying crazy fees, and you can only do it when the banks are open. With stablecoins, we're talking minutes. It costs next to nothing, and it works 24/7, holidays included. It's not even a fair fight. And this isn't just theory. It has huge real-world implications. We're talking about businesses making faster, cheaper international payments, families sending money back home without losing a big chunk to fees. And maybe most importantly, for people living in countries with runaway inflation, a stablecoin pegged to the dollar can be an absolute economic lifeline. And this all leads to the final piece of the puzzle. And honestly, it might be the biggest one. Because this isn't just about cool new tech anymore. The future of money has become a geopolitical battleground. You basically got two camps forming. On one side, you have the US approach, which is kind of like, hey, let the private sector innovate with dollar-backed stablecoins. This helps keep the US dollar at the center of the global financial system. But then you have the EU and others who are more cautious. They see these private currencies as a potential threat and are working on their own official state-controlled digital currencies to maintain control. So that brings us right back to where we started. The big question, is this the future of money, or is it a house of cards? Well, the real answer seems to be, it's a bit of both. The technology itself has incredible potential, but we've seen firsthand how fragile some of these designs can be. The fate of stablecoins isn't going to be decided by clever code. It's going to be hammered out by regulators, governments, and this massive global tug-of-war for who controls the future of finance. This fight over who gets to create and control digital money is going to be one of the defining stories of our time. So if you want to keep up with the big forces shaping our world, make sure you're subscribed. I'll leave you with this to think about. In the future, will your money come from a tech company or from a country? Thanks for watching.